Microeconomics for Investors. Chapter 1. Supply and Demand. Section 1. Market Equilibrium. Market equilibrium is the price and quantity combination where the plans of buyers and sellers match. At that price, the quantity consumers want to buy is exactly the quantity producers want to sell. On a graph, that is the point where the demand curve and supply curve intersect. The price at that intersection is the equilibrium price, and the quantity there is the equilibrium quantity. This does not mean the market is frozen or perfectly calm every second. It means that if price is at that level, there is no built-in pressure from excess demand or excess supply pushing it elsewhere. Prices adjust because imbalance creates incentives. If the market price is above equilibrium, sellers bring more goods to market than buyers want to purchase, creating a surplus. Unsold inventory is costly, so sellers tend to cut prices or offer discounts to move product. If the market price is below equilibrium, buyers want more than sellers are willing to provide, creating a shortage. That scarcity encourages buyers to compete more aggressively and gives sellers room to raise prices. In both cases, the pressure comes from people responding to missed sales, empty shelves, and profit opportunities, and that pressure tends to move price back toward equilibrium. It is important not to load too much meaning into the word equilibrium. In economics, it is a technical term about balance between quantity demanded and quantity supplied, not a statement that the outcome is fair or desirable. Some buyers may still feel the price is too high and choose not to buy. Some sellers may feel the price is too low relative to their hopes and choose not to participate. The market can still be in equilibrium even when many individuals are dissatisfied. So equilibrium tells us where plans line up, not whether everyone approves of the result. A simple market analysis usually starts with 4 steps. First, picture the supply and demand curves, even if only conceptually. Second, compare the current market price with the equilibrium price implied by those curves. Third, ask whether that price would create a surplus or a shortage. Fourth, trace the likely direction of price adjustment. This sequence is powerful because it works for groceries, apartments, labor markets, and commodities. For investors, it creates a disciplined way to move from market facts to a likely price and quantity story. One of the most common errors in microeconomics is confusing movement along a curve with the shift of the curve itself. If the good zone price changes, buyers or sellers move to a different point on the same demand or supply curve. That changes quantity demanded or quantity supplied. But the curve itself has not moved. A shift happens only when some other factor changes, such as income, tastes, technology, or input costs. In that case, the whole demand curve or the whole supply curve moves left or right. That distinction matters because shifts create a new equilibrium, while movements along a curve are part of how the market responds to price. A simple schedule can reveal equilibrium even without drawing curves. In this coffee bean market, when the price is $10 per pound, quantity demanded is 700 pounds, and quantity supplied is also 700 pounds. Because the two quantities are equal at that price, $10 is the equilibrium price. The matching quantity, 700 pounds, is the equilibrium quantity. At nearby prices, the two sides do not line up the same way, so this row in the schedule gives us the market clearing outcome directly. Looking above and below that equilibrium price helps explain why the market tends to return to it. At $12 per pound, suppliers want to sell 900 pounds, but buyers want only 500 pounds. That leaves a surplus of 400 pounds, and sellers facing unsold coffee have an incentive to lower price. At $8 per pound, buyers want 900 pounds, but suppliers offer only 500 pounds. That creates a shortage of 400 pounds, which puts upward pressure on price. The equilibrium price of $10 sits between those two imbalances because it is the point where neither side is left with excess plans. Equilibrium is not permanent because supply and demand can shift when conditions change. Demand might move because income rises, tastes change, or population grows. Supply might move because technology improves, wages change, or a crop failure reduces output. In the coffee market, a drought is a classic negative supply shock. It shifts supply to the left, meaning less coffee is available at every price. With demand unchanged, the new equilibrium usually has a higher price and a lower quantity. So when investors observe price moves, the crucial question is often not whether price changed, but which curve moved and why. You can often narrow down equilibrium even when you do not know the exact answer. In the used textbook market, a price of $30 leads to 200 books supplied and only 50 demanded, so there is a surplus of 150 books. A price of $10 leads to 80 supplied and 182 demanded, so there is a shortage. If one price is too high and another is too low, the equilibrium price must lie somewhere between them. That is already a useful conclusion because it tells you the direction of likely adjustment from either side. Market reasoning often works by bracketing the answer before calculating it precisely. Several mistakes can weaken equilibrium analysis even when the graph looks familiar. One is treating equilibrium as if it means fairness, which it does not. Another is assuming equilibrium stays fixed even though supply and demand regularly shift. A third is mixing up a movement along a curve with a shift of the curve itself. And a fourth is assuming a surplus or shortage can persist indefinitely without market pressure to correct it. Good analysis stays precise about definitions, drivers, and the direction of adjustment. This basic framework matters because the same logic shows up in many markets investors care about. Commodity prices often jump when supply is disrupted by weather, war, or transportation problems. Rents and wages also reflect market clearing forces, even if adjustment is sometimes slow. Some asset prices can be understood through shifts in willingness to buy and willingness to sell, especially in the short run. Equilibrium analysis helps you think not just about price, but about quantity, participation, and the likely path of adjustment. That makes it a practical tool for interpreting news rather than just an academic diagram. Section 2. Supply shocks. A supply shock is a sudden and unexpected change in how much producers can supply. The key idea is that it affects supply across many or all price levels, so the whole supply curve shifts. This is different from a movement along the supply curve, which happens when the goods' own price changes. If price rises and firms produce more, that is not a supply shock. A shock means the underlying production conditions changed abruptly, as with a factory fire, an export ban, or a crop freeze. For investors, the words sudden and unexpected are especially important because markets react most strongly when they are caught off guard. Not every supply change qualifies as a shock. Firms regularly adjust to wages, technology, maintenance schedules, and seasonal patterns, and many of those changes are gradual or anticipated. A true shock stands out because it arrives quickly and leaves little time for preparation. Since the market is unprepared, prices and quantities can move sharply in a short period. That timing difference matters as much as the direction of the change. Two events can both reduce supply, but the unexpected one usually creates a more dramatic, immediate market response. Supply shocks can be negative or positive. A negative supply shock shifts the supply curve left, meaning less is available at each price. Holding demand constant, the usual result is a higher equilibrium price and a lower equilibrium price and a lower equilibrium quantity. A positive supply shock shifts supply right, meaning more is available at each price. In that case, the usual result is a lower price and a higher quantity. The basic rule is simple. Less available tends to push price up, and more available tends to push price down. A shock changes equilibrium because the old market clearing point no longer clears the market. Before the shock, buyers and sellers were matched at some price and quantity. After a negative supply shock, that old price is typically too low relative to the reduced availability of the good, so a shortage emerges. After a positive supply shock, the old price can be too high relative to the new abundance, so a surplus appears. Those imbalances create pressure for price and quantity to move toward a new equilibrium. So equilibrium changes not because the concept failed, but because the underlying conditions changed. After a supply shock, markets usually adjust in a sequence rather than all at once. First, an unexpected event disrupts production, transportation, or access to key inputs. Second, the supply curve shifts because sellers can no longer offer the same amount at existing prices. Third, market participants begin moving toward a new equilibrium through changing prices, revised orders, and altered production plans. But the adjustment is rarely instant because inventories, contracts, regulations, and shipping limits slow the process. In many cases, the first price move is the sharpest. and later changes reflect the slower work of adaptation. The short run and the long run can look very different after a shock. In the short run, supply is often hard to expand because factories, farms, and logistics networks cannot change overnight. That is why prices may spike immediately after disruption. Over time, producers may repair capacity, new suppliers may enter, and consumers may switch to substitutes. As those adjustments accumulate, the market may partly or fully recover. Even so, a temporary event can leave lasting effects if rebuilding capacity takes months or years. The orange market is a classic example of a negative supply shock. If a severe freeze destroys about 30% of the crop, fewer oranges reach retailers and juice processors. That shifts the supply curve left because there is less fruit available at every price. In the short run, the equilibrium price can rise sharply, such as from $1.80 to $3.20. Consumers then respond by buying fewer oranges or switching to other drinks. The higher price is not just a random spike, it is the market's way of rationing a suddenly scarcer product. Recovery can remain incomplete even after the original event ends. In agriculture, replanting takes time, and new groves need years to mature before full production returns. That means supply may shift back only partially rather than all the way to its original position. As a result, prices can fall from the emergency peak, but still remain above their old baseline. A later price of $2.10, for example, would show that the worst shortage has passed, but the market has not fully recovered. Investors often miss this middle stage by assuming a temporary shock must have a temporary impact. When a disruption is temporary, the smartest response is often to manage scarcity rather than overcommit. Raising prices can slow the sales pace and preserve limited inventory for customers who value the product most. Limiting units per customer can spread supply more evenly and reduce panic buying. Clear communication about delays helps maintain trust and reduces confusion. At the same time, firms should be cautious about over-ordering at premium emergency prices if the shortage is likely to fade soon. Good management distinguishes between a short-run interruption and a lasting structural change. Short price moves invite misinterpretation, so it helps to slow down and ask a few disciplined questions. A jump in price does not automatically mean the new level will last. A temporary surplus or shortage can disappear as the market adjusts. It is also easy to confuse a supply shock with a demand shock, even though the quantity effects usually differ. The central question is whether the change is temporary or persistent. That one distinction often determines whether a price move is noise, a short-lived disruption, or a meaningful long-term signal. Section 3. Demand drivers. Demand analysis begins with one big distinction. If the goods' own price changes, consumers move along the existing demand curve and quantity demanded changes. But if something else changes, such as income, tastes, the price of a related good, expectations, or the number of buyers, then the whole demand curve shifts. A demand shift means consumers want more or less at every possible price. That matters because a shift in demand can create a new market equilibrium. So, before predicting price or quantity, you first want to ask whether you are dealing with movement along a curve or a shift of the curve. There are 5 core demand drivers worth memorizing because they explain most real-world shifts. The first is consumer income. The second is the prices of related goods, such as substitutes and complements. The third is tastes and preferences, which can change with trends, reviews, and branding. The fourth is expectations about the future, especially future prices or income. The fifth is the number of buyers in the market. When any of these changes, demand may rise, fall, or remain unchanged, depending on the context. Income does not affect all goods in the same direction, so you must classify the good first. For a normal good, higher income increases demand because consumers buy more as their purchasing power rises. Travel and restaurant meals are common examples. For an inferior good, higher income reduces demand because consumers switch toward preferred alternatives as they become better off. Instant noodles or some categories of used clothing can fit that pattern. The important point is that normal and inferior refer to how demand responds to income, not to whether the product is objectively good or bad. The prices of related goods can shift demand in predictable ways. Substitutes are goods that can replace one another, like coffee and tea. If the price of tea rises, some consumers switch toward coffee, so demand for coffee increases. Complements are goods used together, like printers and ink. If the price of printers falls, more printers are bought, which can raise demand for ink. So a price change in another market can shift demand in this market even when this good's own price has not changed. Some demand shifts come from changing behavior or changing expectations rather than direct changes in price or income. Preferences can move because of fashion, reviews, social influence, or new information about quality. Expectations also matter because people often buy earlier when they expect future prices to rise. If consumers think a popular device will cost more next month, some purchases move into today. Market size matters too, since more buyers generally shift demand to the right. Population growth, migration, or a new office district can all expand the customer base and increase demand. A reliable way to analyze demand changes is to follow a short sequence. First, identify exactly what changed in the market environment. Second, decide whether that change would make consumers want more or less of the good. Third, shift the entire demand curve right for an increase or left for a decrease. Fourth, combine that new demand curve with supply to assess the new equilibrium. This process helps prevent common mistakes because it forces you to name the driver before drawing conclusions. For investing and business decisions, that discipline is often more valuable than memorizing isolated examples. When demand shifts and supply stays the same, equilibrium usually moves in a predictable direction. A rightward shift in demand tends to raise both equilibrium price and equilibrium quantity. A leftward shift tends to lower both. But the size of those changes depends on supply conditions. If supply is very fixed in the short run, demand changes show up mostly as price changes. If supply is very elastic, firms can expand output more easily. So the same demand shift produces a larger quantity response and a smaller price response. Consider luxury cars in a city where household income rises by 15%. If luxury cars are a normal good, consumers will want more of them at any given price, so demand shifts right. At the same price of $40,000, quantity demanded rises from 200 cars to 800 cars to 800 cars. Because the price itself did not change in that comparison, this is not movement along the demand curve. With supply unchanged, the new equilibrium might move to about $44,100 and 1,650 cars. Notice the logic: buyers shift demand, then producers respond by moving along the existing supply curve to a new market outcome. Real markets often face multiple demand forces at the same time, and they do not always point in the same direction. Higher income may push demand for cars to the right because more households can afford them, but improved public transit may push car demand left because some commuters no longer need to buy one. The final market effect depends on which force is stronger. In some cases, demand clearly rises or falls, but in others, the net direction is ambiguous. That is why one headline is rarely enough to explain a market move. The coffee market offers a good practice case because several different drivers can appear at once. A new office complex adds more nearby buyers, which shifts coffee demand right. Positive media coverage improves preferences, which also shifts demand right. But if tea gets cheaper, some consumers substitute away from coffee, shifting coffee demand left. Looking at these separately is easy. Combining them is harder. The overall effect is ambiguous, because two rightward forces and one leftward force are competing, and we need more information to know which dominates. Most demand mistakes come from using the right words in the wrong situation. A change in the good's own price does not shift demand. It causes movement along the demand curve. Income does not always raise demand, because some goods are inferior rather than normal. Substitutes and complements are also easy to mix up, but they have opposite demand implications when related prices change. Expectations and short-lived trends matter too, even when they do not last long. A good habit is to ask, before anything else, whether you are looking at a price movement on the curve or a true shift of the curve. Section 4. Elasticity Basics. Supply and demand tell us the direction of change, but elasticity tells us the size of the response. Two markets can both face a price increase, yet one may experience a large drop in quantity while the other barely changes. That difference is what elasticity measures. It is useful for managers deciding whether to raise prices, for investors thinking about revenue sensitivity, and for anyone comparing markets with different customer behavior. The idea applies to both demand and supply. In short, Elasticity turns direction into magnitude. Price elasticity of demand measures the percentage change in quantity demanded caused by a 1% change in price. The basic formula is percentage change in quantity demanded divided by percentage change in price. Because demand curves slope downward, the raw number is usually negative, price goes up, quantity demanded goes down. In practice, we usually focus on the absolute value, because the key question is how strongly buyers respond. If a 10% price increase leads to a 20% drop in quantity demanded, demand is quite elastic. If the same price increase leads to only a 5% drop, demand is inelastic. The absolute value of elasticity gives us three useful categories. Demand is elastic when quantity changes by a larger percentage than price, so the absolute value is greater than 1. Demand is inelastic when quantity changes by a smaller percentage than price, so the absolute value is less than 1. Demand is unit elastic when the percentage changes are equal and the absolute value is exactly 1. That middle case matters because total revenue stays unchanged when price changes. These categories help translate a number into an economic story about customer sensitivity. Price elasticity of supply works the same way on the producer side. It measures the percentage change in quantity supplied divided by the percentage change in price. If supply is elastic, firms can expand output relatively easily when price rises. If supply is inelastic, output is difficult to increase even when price becomes more attractive. Short-run limits like capacity constraints, scarce inputs, or long construction times often make supply less elastic. Over longer periods, producers usually gain more flexibility, so supply tends to become more elastic. Elasticity depends on how easily people and firms can adjust. Demand becomes more elastic when there are many substitutes, because consumers can switch away more easily. Necessities tend to be more inelastic because buyers keep purchasing even when price rises. Longer time horizons usually increase elasticity, since both buyers and sellers have more time to adapt. Large budget items also tend to be more elastic because consumers pay closer attention when more money is at stake. On the supply side, flexible production, spare capacity, and alternative inputs all make quantity supplied more responsive to price. The midpoint formula gives a consistent way to compute percentage changes between 2 points. Instead of dividing by the starting value, it divides by the average of the two values, which avoids getting different answers depending on the direction of change. For quantity, we take Q2 minus Q1 and divide by the average quantity. For price, we take P2 minus P1 and divide by the average price. Then elasticity is the percentage change in quantity divided by the percentage change in price. This symmetric approach is especially helpful when comparing market data over time or explaining elasticity in both directions. Take a simple demand example where price rises from $5 to $6 and quantity demanded falls from 100 units to 80. Using the midpoint formula, the percentage change in quantity demanded is negative 22, 2%. The percentage change in price is positive 18, 2%. Dividing those gives a demand elasticity of about negative 1, 22. In absolute value, that is 1, 22, which means demand is elastic, so buyers responded more than proportionally to the price increase. Elasticity is especially useful because it helps predict what happens to total revenue when price changes. If demand is elastic, a price increase reduces revenue because the loss in quantity sold outweighs the higher price per unit. If demand is inelastic, a price increase raises revenue because quantity falls only a little. If demand is unit elastic, revenue stays roughly unchanged. In the example here, revenue falls from $500 to $480 when price rises, which fits elastic demand. The simple rule is that elasticity tells you whether quantity or price is doing more of the work. Comparing markets makes the revenue rule easier to remember. A coffee shop may face highly elastic demand because customers can switch to tea, brew coffee at home, or skip the purchase entirely. In that case, a price increase can cause revenue to fall, such as from $800 to $630. Gasoline is different in the short run because many drivers still need to commute and have limited substitutes. With inelastic demand, a price increase can raise revenue, as in the example from $3.00 to $3.234. The same action, raising price, can produce opposite revenue outcomes depending on elasticity. Most elasticity mistakes are about interpretation rather than arithmetic. One common error is using a simple percentage change instead of the midpoint formula, which can create inconsistent answers. Another is worrying too much about the negative sign on demand elasticity when the real classification depends on the absolute value. It is also important not to confuse elasticity with slope, because slope depends on units while elasticity is a percentage-based measure. Finally, do not ignore time horizon or revenue effects. Elasticity is valuable precisely because it connects customer response to pricing power and business outcomes. Section 5. Price discovery. Price discovery is the process through which markets figure out what an asset is worth right now. It is not a single moment or a fixed announcement. It emerges from bids, asks, and completed trades as buyers and sellers reveal what they are willing to pay and accept. As new information arrives, those quotes and trades update continuously. That means market value is always provisional, reflecting the latest interaction rather than a permanent truth. For investors, price discovery is the live mechanism behind every quoted price on the screen. Price discovery and equilibrium are related, but they are not the same thing. Price discovery is the process of adjustment as orders arrive, information changes, and traders revise their views. Equilibrium is a state where buying and selling plans are balanced at a moment in time. In actual markets, that balance is often temporary, because new orders keep appearing. So equilibrium is like a snapshot, while price discovery is the movie. Understanding both helps explain why markets can seem balanced one moment and moving again the next. The process unfolds through a repeating sequence. Buyers enter bids, showing the prices they are willing to pay, while sellers enter asks, showing the prices they are willing to accept. The highest bid and the lowest ask define the inside market, and the gap between them is the bid-ask spread. A trade happens when one side accepts the other side's price, either by a buyer lifting the ask or a seller hitting the bid. After the trade, quotes often update as participants react to what just happened. That cycle repeats constantly, which is how markets search for current value. The bid-ask spread gives a quick reading of market conditions. A narrow spread often suggests active trading, stronger liquidity, and relatively close agreement about value. A wide spread can signal low liquidity, greater uncertainty, or both. In thin markets, buyers and sellers may be far apart because each side is cautious about getting stuck at the wrong price. Spreads also change with news, since uncertainty often widens them before confidence returns. So the spread is not just a technical detail, it is a live signal about how easy or difficult it is to trade. Order flow can move prices even before the whole market settles on a consensus. A large buy order reveals stronger immediate demand because someone is willing to pay through existing ask prices. A large sell order reveals stronger immediate supply for the same reason on the other side. Those orders can also tighten or widen spreads, depending on how they change the balance of quotes in the book. This is why the last trade alone is not enough to understand the market. To read price discovery well, you need to think about the ongoing pressure from current bids, asks, and incoming orders. A concrete example makes this easier to see. Suppose the initial bid is $4 and the initial ask is $4.50, so the spread is 50 cents. That wide spread tells us buyers and sellers disagree quite a bit about value. Then a 10.00 unit buy order arrives and lifts the $4.50 ask, signaling stronger demand than the market had previously observed. In response, quotes adjust upward and closer together, perhaps to a $4.40 bid and a $4.45 ask. The market has not found one eternal true price, but it has become more confident about a tighter range. After that large buy order, the market often becomes more competitive around the new information. The spread shrinks to just 5 cents, and prices begin clustering around $4.45 to $4.55. A narrower spread suggests better agreement between buyers and sellers and usually better liquidity as well. This is price discovery in action. Disagreement is reduced through trading and quote revision. Notice that the market is not necessarily calm forever after that. It has simply found a tighter and more informative range for now. Price discovery does not end once a spread narrows. Fresh information can quickly reopen disagreement and widen the spread again. Imagine a factory shortage becomes known. and sellers raise asks to $5.10 while buyers lag at $4.80. The spread widens to 30 cents because sellers react first and buyers are not yet willing to match them. As more trades occur, both sides update their views and the market may meet near $4.95. That sequence shows how new information changes expectations first and trading works at the new price after. Investors should care about price discovery because the quoted price alone does not tell the whole story. Good price discovery means prices reflect current information reasonably well and can be traded around with relatively low friction. It also helps you judge how easy it will be to enter or exit a position without moving the market much. Spreads reveal liquidity and uncertainty, so they are part of the investment signal, not background noise. Price discovery can even explain moves that occur before the full news story is obvious in headlines. In that sense, the process can be as informative as the final print. Several common mistakes can cause investors to misread market signals. One is confusing the process of price discovery with equilibrium, as if markets must always sit at one settled point. Another is treating the last trade as the full story instead of checking the current bid, ask, and order flow. It is also a mistake to ignore spreads, since they often contain information about liquidity and uncertainty. Prices do not always adjust instantly, especially in thinner or more stressed markets. And in many cases, the market is really identifying a range of plausible values rather than one perfectly precise number. A quick spread exercise ties the mechanics together. If the bid is $27.40 and the ask is $27.60, the dollar spread is 20 cents. To express that as a percentage, divide the spread by the ask and multiply by 100, which gives about 0.72%. That tells you how large the trading gap is relative to the quoted selling price. If a large buy order then enters, it may lift the ask and pull quotes closer together, perhaps moving the market to a $27.50 bid and a $27.55 ask. The narrower spread would signal stronger demand and improve short-run agreement about value.